Well, thank you very much for joining us. It's great to see some familiar faces from last week. My name is Peter Van Roon. I'm Sales Manager, Small Business with RBC, and we have a team of 14. I manage the Ottawa regions, and we have a team of 14 account managers, business and personal, to take care of the Ottawa needs. Some of you I see here are clients. Thank you very much, and the others, I'd be happy to talk to you after. About 2-3 months ago, Welch, Robertson, Hill, and McDougall, Welch and Co. and ourselves sat down and thought there might be a good opportunity for our mutual clients to get some free advice. It's really very much from a high level, but as we sat around the table, coming up with potential topics, it was amazing how much actually was left off the table. So this is meant as a very high level view. May create some pain points for you, which is fine. Make you ask some questions of yourself. I want to talk to you a little bit about. We got 2 more series coming up after this. We've got one next week is going to be on protecting your business. So there'll be a good discussion around protecting your IP, that sort of thing. And then the week after that, so we do have morning and afternoon sessions, Tuesday mornings and Thursday afternoons at different locations. And then the week after that is on exiting your business. And there's actually a nice tie-in between today's topics and exiting your business because when you're exiting your business, you want it to be worth as much as it possibly can. So today's agenda. We've got RBC is going to be speaking about how we can help you retain your employees, how banks can help you retain your employees. Sounds like a reach, but it's not. We've got Bron Vasich and Candace Enman speaking to us from Welch, and then we've got Josh Moon and Lorraine Mastersmith from Purley, Robertson, Hill, and McDougall.
I'm from RBC. My name's Tyler Ray, and I'm with our Group Advantage department, and that involves me specializing in going in and talking to companies, business owners, about ways they can retain their employees and work on financial benefits. Specifically, sometimes that rolls up into retirement benefits, but there's a more comprehensive view we tend to look at in terms of financial wellness in the workplace. So what I was going to address today, what I thought was of value, was some of the key factors that a lot of the industry leaders look at when they're attracting and retaining top talent. Wanted to address providing more value for money spent on employee benefits because that comes up in a lot of conversations I tend to have with employers, as well as promoting financial wellness, which is a relatively new term and topic that's coming up in a lot of different workplaces, and some best practices around being creative with R&R in your own workplace. Reward and recognition. So when we talk about attracting and retaining top talent, we know that it's really important because of the cost involved when we lose employees and the cost involved in having to replace them. We know that many employees, the vast majority of them, are considering with some degree leaving the company for other options at some point during their career. We've pinpointed a few different areas where that is more of a touch point. So for example, IT and marketing professionals, workers aged between 41 and 45, because that's sort of their last chance at switching careers. If they don't do it by that point, usually they're sticking with where they're at. Directors and supervisors, again, very competitive marketplace for them. And employees that are paid average or below average wages, because they're always looking for better options that are out there. So that encompasses a fair amount of the workforce when you look at it that way. We know that when you have turnover, it can cost your company 50 to 75% of the employee's salary when you're dealing with training and getting someone back up to speed, and what that does to your productivity when you are replacing that individual. When we talk to employees, we look at employee benefits as one of the areas that they value in terms of when they come to work for a company and if they want to stay with a company. So 60% of them are telling us that the employee benefits offered to me are an important reason why I remain with my employer, and half of them are saying that's part of the reason why they came to the company in the first place, is the package of benefits that are being offered. So when I look at industry trends, right, if you ask an employee to put these things in order, wages, comprehensive insurance benefits, and retirement benefits, they're going to list them in that order all the time. They say, what's the most important thing to me? My salary, my insurance, coverage, and then my retirement. But the gap isn't as big as you think between those three aspects. They're very tied together, and employees are looking for all three. They're not just looking for one. They want to have the entire package. So consequently, employers are looking to review what they have in these particular areas to assess the value that they're getting for their money. If they're paying for these things, are they getting their bang for their buck? And as well, are my employees engaged in this? And what I'm putting out there, do they understand what that is, and are they happy with it? Do they fully appreciate what it is that we're putting on the table for them? Because otherwise, it's a sunk cost. Again, I look at industry trends, and I'm talking more specifically now about retirement benefit plans, because that's where my area of expertise lies. What we've seen in the last 20 years or so is defined benefit pension plans that have been offered becoming defined contribution plans, and that's for a variety of reasons, most of them having to do with a risk taken on by the company, which lies in DB plans, all with the company, whereas DC, it's spread out more with the employee. You don't see DB plans hardly at all, except for some of our bigger entities at this point, and I'd say even within the next 10 to 15 years, you won't see them at all. And a more recent trend is you see DC plans have now been moving into group RSP plans. Okay, and the reason why is that there's a lot of DC plans and group RSP plans have the exact same net effect. They accomplish the same goal for retirement planning. They're very much an apples to apples type of product, but there's more flexibility with both the company and the employee with group RSP plans. There's reduced employer risk involved because the financial institution is taking that on with group RSP plans. In terms of reporting, administrative, all that falls upon the provider as opposed to the company. And there's an increased employee engagement in a company plan because, again, it's being explained more. Group RSP plans tend to have more hands-on management from for the provider themselves. I'm not going to dwell on a lot of the details. A group retirement savings plan, really the major point of benefit when you have something like that is just the same as when you have a defined contribution pension, in that it's retirement savings that are contributed at source, so pre-tax, and that's really where the benefit lies. It's taken off as a payroll deduction, and sent directly to an employee's RSP that they hold in their own name. Again, regulated by the government. It's a government plan. After that, it acts just the same as a normal RSP that anyone would hold that in. Employer can also contribute on the employee's behalf and also use things like deferred profit sharing plans and things like that in order to provide some restrictions and some rules around the withdrawal of the funds and be able to keep it sticky with the company. There are vesting options that can be put in place as well, just like with pensions. So they, like I said, accomplish a lot of the same types of goals that a pension plan does, but they are much more flexible in the way they're accessed. A lot of people like to use the spousal option, which again does not exist with a pension. And for some employees, that does make, if there's a disparity in spousal incomes, that's a great option for them to have and have it directed that way. The withdrawals are something in terms of options where you have companies that like to have the option for allow the employee to withdraw for things like first-time homebuyer plans and lifelong learning plans, which are generally accepted practices within RSPs, and that's tax-free withdrawals. That's another nice bonus feature for those types of plans. So again, I'm not going to get into every single aspect of an RSP, but certainly there's a lot of value that happens as a result of that. Moving on to what financial wellness is and why that's important and why that rolls into when you have financial benefits, you really want the employees to engage and and understand where there's value and why the company's putting that in place for them, instead of maybe giving them the huge raise, right? Having money directed into a group RSP. Many financial institutions are using financial wellness in the workplace, and again, it's the balance between having a healthy state of well-being while being prepared financially for tomorrow. So that usually involves just sitting down with an expert and talking about that, your particular situation around your finances, and it's not just about your retirement situation, it's your overall immediate needs, and that's great for some companies that have younger employees that maybe, I'm a 22-year-old, I don't really have a huge priority on my retirement, but I do want to buy my next vehicle, or I'm getting married and I want to start saving for those types of opportunities. So knowing that you have that ability, and after you've sat down and chatted with someone, is big. It's not necessarily about being wealthy. It's a state of psychological well-being in which one feels they have control over their current finances. And that's very important for employees. When we asked them, 87% would like some form of financial education. And if you look down here and the bubbles, the place they would most like to receive it is during work hours. Okay? There's reasons for that, obviously. And many of them will say they're busy and they don't get to, and we know that they don't seek out that advice on their own time often. So for employers to be able to deliver it to them in the workplace without it, affecting their overall productivity, that's important for them to be able to receive it that way. And financial institutions are now, with increased mobility, are able to provide that. I wanted to just leave off with a couple. I've come across a few really best practices for some ways that companies are finding creative ways to enhance their employee benefits. So one of the ways they're doing is providing reward and recognition programs, which we know are very important to employees, and that should have some kind of presence in the workplace that encompass the benefits. So for some companies, they've done things like allocated performance bonuses to their retirement plans, whether that's a quarterly or annual bonus, and it's a portion or a full amount. And the reason why they might do that is first of all to help promote the stability of staying with the company and building towards their future, but also to tax shelter that money, and it doesn't get taxed at source. They get to keep it in their RSP until it's time to withdraw it at a date that's more advantageous to do that withdrawal. And they also build the performances around some of their performance measures, whether that might be just individual results, but also doing things like completing a project on time. That there's a mass bonus that goes out, and it can be a very small amount, but trying to drive certain behaviors, perfect attendance. There's a variety of different tactics that you can use to drive certain behaviors within your workforce. And the last part is looking to find ways to enhance their existing benefit packages through other non-traditional means, and that's usually at finding ways that are at no additional cost to the company, which is obviously very important. A lot of companies have credit cards that they use, and they earn points on them for the company, and a lot of times those points build up. Companies tend to now use them to redeem the points for whether they're gift cards or whether they're specific travel rewards, and then use that as reward and recognition for their employees, and that way they're not having to dive into their budgets to provide that type of R&R. Other aspects, again, is finding partners that will work with them, like banks, where they can have rewards at minimal or no cost to the company, like discounts on banking products and reward points on specific cards that are exclusive to the employees of the company, and that helps beef up their entire benefit package. RBC does provide that area of advice too, even though I'm not selling today. Yeah, so that was basically all I wanted to cover off today. I know we have a short period of time, but I would be happy to answer any questions that you guys have. That's there specifically so you can't read it, but yeah. Afterwards, and I'm available for any kind of. I have lots of other things that I could delve into, and I'd love to with you. So thank you for your time.
So unfortunately, we know that there's no magic wand out there that is available to business owners that they can magically wave and create or increase the value of their business. And in fact, we know it's actually a lot of work in order to increase the value. Owners have a value challenge. They need to be able to create a business that someone will ultimately want to sell or buy, excuse me. So we know that here at Welch, we've coined the phrase basically, you need to build your business to last decades, but be prepared to sell it tomorrow. So we want business owners to always be thinking about value creation. And we get it. It is hard to do, and it might not be reality because business owners are often wearing multiple hats. The owner and the CEO are often the same person, and they're down in the trenches. They are fighting those operational fires on a daily basis. But if they're not able to take themselves out of those fires and start to think and act strategically, then it's going to be very difficult for them to create those business decisions that are going to enable them to increase the value of their companies. So what we never want business owners doing is really chasing revenue or profit or EBITDA as the sole source of value creation in their companies. Because if they're doing this, they're going to leave a lot of value on the table. So we want them to recognize that all of these items here on this chart actually help a company create value. So do you have well-defined processes in place? What is your infrastructure? What's your operations, your sales, marketing, your financial management? All those items are not found on the balance sheet, yet they're critical to value creation. We want private business owners to understand that value is really defined as profit that is sustainable and transferable. So sustainable is the company's ability to maintain its performance over an extended period of time, and transferable is the company's ability to maintain its performance without the current owner in charge. So in order to maximize your business, and chances are it's going to be your largest asset, we want business owners to ask themselves, do you know the value of your business? And is that value defensible? What is it based on? Is it what actually can be gotten in the market today? So can you support that valuation? Or is it just a notion of, this is what I want my business to be worth. This is my retirement goal. So again, it has to be defensible. Once you have that value in your head, you also want to ask yourselves, is the value sustainable and then transferable? So can someone else come in and replicate what I'm doing and continue on with the business that I've created? And I think really the key here is to understand the drivers that are going to impact value long-term in your company. So do you understand what those key drivers are? And I run a practice called Chairman's View, and in that practice we've identified 18 key drivers of business value. They're really broken up into two categories. So the first 9 are actually market drivers. So they're all the external factors that can impact your value. So for example, growth. So do you have a trend of historical growth in your business? Is there growth in your market? Is there growth in your industry? Do you have large potential market or dominant market share? Or can you prove that you're going to attain dominant market share? Does your company have recurring revenue? Do you have repeat customers? Or are you a service type business that needs to go out and get new clients every other month? What are the barriers to entry for your business? Capital, market, financial. You want to make sure that it's difficult for someone to enter into your space. Are your products or services differentiated? So do you have a unique offering in your market that is really going to enable you to get margin advantage? So can you demand a higher price? Or are you enjoying, reduced costs so that you're actually making more than your competition? Does your brand resonate in the marketplace? So again, how does it speak to your customers, to your clients? And finally, are you relying on 1 or 2 key customers, or do you have a well-diversified customer base? The last 9 are operational drivers, and operational drivers are really all the internal factors that impact value in your organization. Okay, and they are really going to help describe the quality of the business asset that you're trying to create, and also establish whether your company is going to be sustainable into the future. So company overview. So do you have a very succinct description of the business that someone else will be able to walk in and be able to understand what it is that you do and how you do it? Do you have sound financial management? Do you have sales plans and marketing plans and processes in place to ensure that you can continue to deliver to your customers? Are you delivering to your customers? Do you have a plan in place to track your customer satisfaction? Do you have a solid senior management team in place that enables you to exit the company if that's what you need to be, or just to allow you to help put the infrastructure in place so that you can grow the business to increase its value? Do you have the right people in place? Is your legal house in order? And the final one is innovation. So are you trying to capture innovation? Are you trying to always stay ahead of the curve and make sure that you're competitive? What you need to know is that regardless of the business, you're going to have red flags. So understanding what your key drivers are and where those opportunities lie and where the red flags lie is really critical. So we've determined that 73% of all businesses have red flags. And if your company has red flags, oftentimes those red flags can negate all the value that you've created. If you're willing to work on just the top 5 red flags that you've identified, you'll be able to capture 44% of whatever that value gap is. So again, I go back and I just want to restate that it's important that you understand what are those red flags in your company so that you can begin to address it, because that's going to put you on the path of maximizing or increasing the value of your business. The red flags that we've identified in our program, the top 5 red flags have been the do-it-all business owner. So that's the owner that has the octopus syndrome. So they do have their hands in everything. If they were to leave the business tomorrow, there would be no value in the company. The second one is strategic direction. So where is the business going and how is it going to get there? And is it all in your head or do you have it written down on a piece of paper? Talent management. Again, the right people on the right bus at the right teams. Who is supporting your organization? People are a big asset, right? Financial management. So for me, this goes beyond, compliance reporting, which is important. But do you have the operational reports in place in order to use and build value decisions? So are your numbers defensible, and are you using that information to affect good decisions in the business? And the last one that we see is quantifiable advantage. And again, it's taking a look at whether you have a differentiated product and service, and really whether you're able to capture margin advantage because of that. So how are you doing in relation to your competition? Once you understand what your key red flags are in your business, you need to know how to address them and what to tackle first so that you're getting really your biggest bang for your buck. So it's all about trying to identify them and then really to take action. So in summary, if you're looking at increasing the value of your business, I say the first thing that business owners need to do is really understand what the definition of value is. Don't get stuck on just chasing profit or revenue as your sole source of value, because that's where you're not going to be able to grow. It's about looking at all the drivers, making sure that you're putting in the right infrastructure to position your business for greater transparency, for greater growth, and for some, for an eventual transition. The final point I want to make is that we often hear business owners say, I know what my red flags are. I could do a diagnostics on myself. I know all my major pain points. But if you're not taking action, if you're not doing anything about them, then you're going to be stuck. And you're definitely not going to be increasing the value of your business. So it's all about taking action.
Thanks very much, Candace. Great overview. And there's going to be a little bit of overlap between creating value and valuation. So Bruce Fisher, who's another chairman, and myself created this little presentation. And we're really specifically going to talk about valuation methodology. So what you need to know about valuation is that it's a process, and a little bit different than what Candace was talking about, because she's talking about the internal pieces of an organization that they need to have in place. And I'm really talking about now from the point of view that most businesses and business owners want to know, well, I've been running my business, how much is this worth? How much can I get for it? And the reason that you need to understand what that is that there's a number of planning issues that have to go into that. And Ryan, one of the tax fellows here at Welch, can talk a little bit more about that. But it's about understanding, well, how much is my business worth? Can I do some planning with my family, other tax advantages of using the small business exemption? And what we also need to know is that there's all kinds of different methodologies out there. But Bruce and I agreed that when we did this presentation that we would agree on the valuation process of looking at future earnings, certainly what the past earnings have been, but really basing the valuation on future earnings at a discounted factor. And we'll get into specifically what that is. But also there's lots of different factors that need to be taken into account when you're doing a valuation, and we're going to talk a lot more about specifically what those are as we go along. And as I was mentioning, there is the formula. And just to give everybody a heads up here, there's always rules of thumb. You can go on the internet and get all kinds of different information about business valuations, and there's rules of thumb for businesses. But essentially, in achieving this business valuation, you really want to try to use experts, people that are chartered business valuators, to be able to take it through the process, because there's many little traps you can fall into as you go through this. So as I was trying to describe earlier, the formula that typically Bruce and I agreed, because between the two of us, we've done lots of work in mergers and acquisitions, where both working for the vendor and working for purchasers. And we agreed that typically what people do is they look at the present value of all the future profits discounted for risk. Discounted for risk means, depending on the nature of the business that you're in, is it is it a risky business from the point of view that, as Candace was talking about earlier, is it something that is repeatable and sustainable? Do you have business contracts with people, long-term contracts, or is every sale, every piece of revenue a new adventure? And that's going to account for the different risks that you have associated with that. And there's also the fact that these numbers, you're going to base it on the actuals in the past, and it's going to be based on the future values. Because essentially, when you're looking at buying a business, or you're looking at selling the business, it's really going to be dependent on, yes, it's where you came from, but it's what is the future value? What is the future earning power? And what's the return on investment for me as an investor going to look like? And as, again, building on what Candace was saying, some of the two key factors here in terms of business valuation is that you really have a really good understanding of the financial management, the financial information of an organization. And I would say this is one of the, as Candace pointed out, is a red flag. It's really one of those red flags that should have asterisks all around it, because there's financial information and financial information that goes a lot deeper than simply just a balance sheet and income statement. When potential purchasers are looking, they want to look at, well, what makes up the revenue? What percentage of the revenue is this? What percentage of the revenue is that? What are the seasonalities of it? Who are your key customers? Who are you selling to? they want to have more than simply just the basic financial statement. So having that, an ability and having an information system that you can get the information, be able to drill down into some of those questions is really key to business valuation. And it sounds really basic, but there's really lots of key questions that you need to ask yourself. And these are some of the key questions that you need to consider. You know, how much of the company's top line is recurring revenue? Are there contracts with customers and clients? Or again, is it just every day you're looking for new customers? Or are there repeat performances? And these are some of the real critical things. Does the business have unrecorded assets and liabilities? Does it have intellectual property or patents that aren't on the books? Does it have property or undervalued assets? Now, the real estate, does it own leases? I think everybody read in the Globe and Mail that Sears decision. And who would have thought that the value of the lease that they had on Yonge Street is worth the amount of money they quoted in the Globe and Mail, which is $400 million. And that's certainly not anywhere on the balance sheet. So it's those kind of things that you need to take into consideration. And of course, the customer relations is really a key component. And as Candace was mentioning, again, the critical question is, can the business survive without the owner there? And this is so critical. And as business owners, as entrepreneurs, we run into this all the time. The notion that they need to be in control, they need to be able to do everything themselves. That's really not building a business. That's really basically just creating a job for yourself. And again, we run into that all the time when we're out there doing chairman view projects and working with clients, that, as Candace said, the business owners are stuck. They just don't know how to do it differently. They think that over the years they are gifted, they start doing things in their business, they're very successful. And the interesting thing about people psychologically, and especially entrepreneurs, and probably goes for most of us, they start to give away the things that they're really gifted at because they can easily manage it. So they start giving away the things they're really gifted at because they can manage it from afar and they can control it. And all of a sudden they find themselves in business doing the things they aren't really good at. And all of a sudden they realize, wow, I hate this job. I'm working 24/7 and I'm, marginally making it, and they aren't having any fun anymore. So when I've had this conversation with a number of them about, well, you identify it, and they nod their head, and then just helping them walk along beside them to help them understand that, all right, they need to do ABC to be able to get away from that, hire somebody to do the things that they are doing now, and get out there doing what they love to do. And that's how you be able to building it the way that they originally envisioned. Unfortunately, they just don't have that perspective. And I think all of the chairmen agree that one of the big advantages of the chairman's view is that we give the owners and the corporate owners of the business that different perspective. We give them lots of options of being able to see how they can build their business. And sometimes it's amazing how it's like revolutionary. They go, wow, I didn't really know that. And are there significant capital investments required in the near future? So again, when you're looking down the road, do they need a whole, capital expenditures to just maintain their machinery, maintain their productivity? Are they in an older building that they need to revamp? So that's a big piece of that. So now we're going to get into just visualizing what this market valuation is. And we created this little chart on the left-hand side. The y-axis, I guess, is the free cash flow, and on the x-axis, the time. And I want you to pay attention to that final year used for terminal valuation. And so what we build in here usually is about 6 years worth of future cash flows. So each of those blocks represents a year. And so you take the discounted value of those years, and it's, again, you can see that in the first year, the discount factor isn't very much, and it's sort of the present value of those potential earnings. So you use a present value table, and so it's the value of this is the accumulation of all of these different blocks. Plus, in the final year, you're going to project out a period of time, and there's a very, very high discount factor on that, but it's usually an add-in, and that typically is the value. Now, sometimes depending on the assets that are in the organization, real estate, you're going to have a bump up on that, and so there are different components, and you can use the net book value of the organization plus the future value. And net book value obviously is, for those non-accountants, is the difference between the assets and the liabilities and what the company's been able to retain. As you can see, as the timeline gets out farther, it's discounted for increasing risk. So it's the accumulation of all of that would be the valuation. And what in the calculations, just quickly, that we've assumed a discount risk factor of 25 to 40%. Essentially what you're doing is bringing the cash flow into current dollars, and we're generating a terminal value that brings into the current dollars, and that usually discount rate is about 50%. So you're projecting out and discounting at 50%, and again, this accumulation of all of those things. So in summary, these are the key points that Bruce and I agreed are key for having a good value in your business. Again, it's going to be a little bit of supporting what Candace was saying earlier. To have a current roadmap for your business, have an up-to-date business or strategic plan, that's a key factor. We see so many times, and all of a sudden that, businesses will be running along and somebody will give them a call out of the blue and say, hey, I'd be interested in your business. And when they do the due diligence, all of a sudden companies aren't ready for this. So it's these little points are about having that in that basis of readiness. Don't stop investing for growth. Ensure your business is transferable, and ensure that your personal structure allows you to minimize potential tax liabilities on a sale. So these are the key components that you want as you're building your business, as you think about valuation. That's what you want to have in your business. And I believe we are done with that.
My name is Ryan Dostey. I'm an insurance partner here at Welch. Today I'm going to talk about lease versus buy. I'm sure most of you as business owners have come across this at least one time in your life, whether it's a vehicle, whether it is equipment, or for a building. Do you want to lease the building or you want to buy the building? Overview today, I'm going to talk about cash flow impact of that. I'm going to talk about, I'm an accountant, so I'm really keen on how is this going to impact my financial statement, what's it going to look like. We're going to talk about the tax consequences. I'm going to look at other considerations as well. And what everybody wants to hear in this room is, what is the solution? So let's go right into the cash flow. Typically in a lease situation versus buy, the payments on the lease are going to be lower. You've got to keep in mind, in a lease, you are paying for the use of either that equipment or that car. If we want to take a car example, usually if it's a 3-year lease, there is some value left in that car. You don't have to pay that. That's considered the residual value of the lease. You don't have to pay that. If you're buying that car, yes, you're going to be paying for that. That is why your payments will be more. When we look at the next component, easier to obtain. Leases typically are easier to get. The reason why I want to compare the buying side, obviously the credit comes into effect, whether how good your credit is. You might need personal guarantees that come in that will affect whether or not you could get to buy that equipment. You know what, lease can be very effective in the sense of the lease terms. You can talk to our friends at RBC. I guarantee you they can make the equipment leases a little bit work with you. If you have a special equipment that you want to use for a particular time and you don't want it to carry it over a long period of time, a lease would make sense because they can structure it so that it starts at a particular time and end at a particular time, or be over certain years. So it gives you some flexibility. Lease costs, let's talk about, you own your building. You know what? You have to pay for those costs. You have to pay for the roof goes down. Any costs associated maintaining that building is yours to bear. If you are not the landlord and you're leasing, well, obviously you have to pay some costs, but usually it's the landlord's problem, not yours. In general terms, obviously leasing is more expensive in the long run if we're talking about the same piece of equipment versus if you bought it outright and kept it for its useful life. Okay, how does this impact your financial statements? Let's talk about the various types of leases. There are 3 types. There's a sale leaseback, which we won't get into today, but we'll talk about the other 2, operating versus capital. So what is the distinction between the 2? A capital lease is, I'll give you the example. If you, it's very common when you want to lease a computer. After several years, in the lease agreement, they'll say you can buy that computer for $1. Well, in effect, you've actually paid for that computer. That is considered a capital lease. If you have, and for accounting terms, if you are using that equipment for basically 75% or more of its useful life, that's a capital lease. Now, I wasn't going to go into net present value because, but thanks to Ron here, there is another component that deals with whether the minimum lease payments, 90% of the minimum lease payments, and deals with the net present value, but I wasn't planning to add that in, but thanks, Ron, for bringing that up. So I think we got a clear understanding. If you basically pay for the asset completely, it's yours. It's a capital lease. What does this mean? On an operating lease, if you look at your balance sheet, there's nothing there. In the income statement side, you're going to see the direct charge of that lease. And in the notes to the financial statements, assuming you're on an audit or review, you're going to see that commitment note showing exactly here are the payments for the 5 years or at least to the maturity of that lease. Capital lease, slightly different. You're going to see the assets set up on the books, capital assets set up on the books. On the asset side, you're going to see the related capital lease obligation below in the debt. Keeping in mind that you're going to have to show the current portion of that debt and the long-term portion. That will be an important aspect coming up later on. In your income statement, you're going to see the amortization amount of that capital lease, and as well you're going to see the interest on that capital lease. In the notes, you always have your capital assets section where you have all your other assets. That capital lease will appear there at a separate line. And there's a separate disclosure just on that capital lease regarding the payments, the embedded interest on the capital lease, and the actual interest rate implied. Now, turning to purchase. We're going to go on the fact that you financed it from our friends at RBC. And on the asset side, again, let's say, we're saying a building, for example. The building will appear up on your asset as a building. On the liability side, you're going to have long-term debt. Keeping in mind, again, there's going to be a current portion of that debt and there's going to be a long-term. What does that mean to people around the table here? You might have other loans. You might have other debt. Guess what? You might have covenants. You might have ratios that you have to meet. Otherwise, they might call those loans. So when you're looking at adding an asset, you got to be thinking, how is this going to impact my financial statement? Because if I'm offside by adding this one set of equipment lease onto my balance sheet, that could be a big issue to you. So keep that in mind. That's one thing that people seem to forget. So after I made my decision, what's the impact tax-wise? A lease is a lease. There is no capital leases in the Income Tax Act. At least I haven't read the whole thing. I don't know if you've seen it, it's about this big, but I haven't seen one. There isn't one. For tax purposes, there's differences always in accounting versus tax, and for tax purposes, you deduct the actual amount of the lease. Very key difference. I just wanted to point out here, leasehold improvements, kind of an interesting topic because people do tend to lease properties. And what does that mean? So if you want to write it off for tax, it's usually over the lease term plus one renewal. So if in your lease agreement it says you have multiple lease renewals, you can't write that off over just your current lease. It'll be over the potential renewal as well. So keep that in mind, especially if you're heading into a bigger time frame, when you're adding, if you're doing some big leasehold improvements and you're negotiating with your landlord, and obviously writing off key expenses is quite important to business owners. Moving to the purchase side, there are set guidelines for CRA for various equipments. I just put on some of the big ones here. There's tons of them, manufacturing equipment. But let's look at them. We got commercial buildings, 6%. We have computers currently. Now keep in mind these are current rates. They change depending on what the government feels like. Okay, computers have gone up and down like a yo-yo. They're right now at 55%. We have vehicles at 30%, and as well we have equipment, and we have furniture and fixtures at 20%. Now, keep in mind, in the purchase side, and you're dealing with these various classes, you only can claim half that in the first year. Okay, so it doesn't matter when you buy the asset. You only can get half the depreciation in the first year. So if you're buying a table and desk and chair, it's only 10% in the first year that you claim. It does not matter if it's the very last day of your business or the first day, it's that. So if you're really planning to do some major renos, or you're adding a lot of equipment and you can wait till the end of the year, you're going to get a good deduction right away, even though you just bought it. So keep that in mind. Now, I have these on these slides, one exception and one exception. This is quite interesting. I'm sure a lot of you already know this, but personal vehicles, passenger vehicles, there's exceptions in the Income Tax Act that restrict the deduction of what you're allowed to deduct. If you're leasing the vehicle, it's $800 plus tax. Now that's a lot of vehicle, so you can get a pretty good vehicle for that. Let's, because interest rates are relatively low. On the purchasing side, it's only $30,000. So it's a little bit of a gap difference there, but it is $30,000. So you keep that in mind when you're buying. If you have cars that you think that the staff are using, you're maybe not for yourself. Maybe it's a benefit to one of your staff, and it's still a passenger vehicle. They're using it some personally. Then you got to keep that in mind that you're going to be capped. So it's one thing to think I can write this off to a certain degree, but you're going to get hammered if you buy something a little bit more expensive. So other considerations to think about. How long do I really need this asset? I think I touched on that before when we were talking about equipment and really how long. I really love the car example. You can if you're going to keep your car forever, you don't lease the car. Buy it. You don't own the asset if you have a lease. That is so important. If you're dealing with equipment and if you want to modify anything, or if you want to do something to the equipment that's sort of not part of part of the sort of whatever the equipment you have, you can't do that. If you buy it, you can do anything you want with it. You can sell it, you can modify it, you can make it whatever you want. But the difference is in a lease you can't. It's not yours. Very important these days, leasing does help dealing with obsolescence. You can change over your equipment more often to keep up to date with what's going on in the marketplace, depending on what type of business you are in. Penalties to terminate the lease. You know what? If it's your asset, yeah, you can sell it, but you can't always just hand back the equipment to the lessor without paying some kind of cost. And we'll go back to the vehicles as well. Excess usage. I don't know how many times I've seen it. Clients, they put in their contracts, I'm going to drive 20,000 kilometers a year, and that's what they signed the lease for. Well, they drove 40. So the penalty on that is massive. So keep in mind, if you're going to make these leases, think some more about exactly how much you're going to use this asset and how long. Growth and reduction of your business, and our friends over at Cressa there who likes to lease assets and get tenants in buildings. Well, you know, this is really key. In a lease, we can choose to move to another location once our lease is up. If you own your building, it's a little bit harder to make those modifications to, you know, or granted, you know, we talked about reduction of business. Yes, I can become a landlord and sublease my space, but you know, I was leasing because I didn't want to be a landlord, right? So keep in mind that that's something else you got to really think about. You know, ownership is not always the best strategy. Sometimes leasing is, and sometimes ownership is the best strategy. But what is the solution? It really depends. If you're considering Halloween, you got to look at all the tricks and all the treats, and you got to really factor in everything. You just can't, you know, think you need to really process the information and look at all the factors before you make that final call. And of course, ideally you talk to your banker and as well as your accountant to really get a grasp of what it really means based on the decision you're going to make. So thank you.
So my name's Josh Moon. I'm with Purley Robertson Hill and McDougall. About 40% of my practice is commercial leasing for offices, industrial, retail, a little bit of specialty for laboratories and labs and clean facilities, warehousing. So we've covered a few of the topics already, which is good because I was told I only had 5 minutes. So I'm going to take the tenant's perspective. I could do this from the landlord's perspective, but I'm doing it from the tenant's perspective. And there's some experts here that also have some knowledge base. Martin is over there. And hopefully... So the first thing that I want to note is that the business terms frequently start with an offer to lease. I would say 80% of the time. Occasionally I do have people who show up that they've moved directly to the lease as the first stage, but mostly it's an offer to lease. And everybody's talking about the business terms and they're using agents and they're working on those business terms and they forget that there are legal issues that are in the offer and that they can get trapped by an offer if it says that once you've signed the offer, you have agreed to sign the lease on these terms, but for your lawyer's review of only the legal issues. And frequently there's business issues that have to be addressed still in the lease. Easy answer, put a clause in there that just says your lawyer's got 3 or 4 days to review it and you can refuse to waive the condition for any reason whatsoever. It's dead easy. We talked about leasehold improvements. I'm going to take a little kernel that will save you grief. Almost every commercial lease, particularly in office situations, office and retail, says that at the end of your term, you have to remove all of the leasehold improvements. And it gets buried in there and people don't see it and they don't notice it. And that is the leverage for the landlord at the end of the term to say, well, your cost of moving is not just the cost of the moving truck and moving the phones and stuff. Your cost is removing all the leasehold improvements. And that's the walls and the carpets and the doors and the plumbing and the electrical and the telecom. And it could be anywhere between $4 and $10 a square foot in broad terms. In retail and industrial, you really don't have a lot of room to negotiate that because they want the retail strip, they can't reuse it. But in office area, in the office space, I have been successful in negotiating that clause for office. And there's different techniques and there's different ways to balance the risk between the landlord and the tenant, or to fix the amount that has to be paid at the end, or determine whether the next tenant coming in can reuse any of the space. There's a whole bunch of techniques, but if you get nothing else out of today, if you're leasing, remember to look at the leasehold improvement clause, and I see Martin's nodding, and just see if there's any room to negotiate on it. Operating costs and taxes, just make sure you know what's included in the extras. get a covenant from the landlord as you're discussing the business terms, what the operating costs and taxes actually are. Not an estimate. Say, what were they this year, so that I know what they are going forward, and I can do an estimate of what they might increase by. Is the management fee fair and reasonable? And of course, a lot of landlords don't want to negotiate the management fee because that's part of their revenue stream, or they've hired a third-party manager, and that third-party manager is being paid from that management fee. But occasionally you can be successful in negotiating the management fee. Basically, it's about knowing all your costs up front, and there's a lot of buried costs in a commercial lease. And whether it's your lawyer or a really sophisticated commercial real estate broker like Martin, there's a free plug for the day. You owe me a beer. You can go through and dive into the details because there's a lot of hidden costs beyond just the rent and just the operating costs and taxes. Covenants and insurance, kind of two topics. Startup businesses, frequently they want personal covenants. Are they required? Can you negotiate your way out of them? Can they be limited? One successful technique I've had is saying that it's a 5-year lease with a 5-year renewal. So long as the tenant has paid all of their rent on time and abided by all the rules of the lease, at the end of the 5 years when they renew, their personal covenant is removed, and they only have to have a corporate covenant. That's one example. But that's really important because the personal covenant is a personal liability for the rent. And it's a risk management thing. You want to manage the risk and shift the risk to your business and not have it on you personally. I'm not an insurance expert. I don't pretend to be one, but I do know how to read the insurance provisions of a commercial lease. They're technical, they're detailed. I always say, bring your insurance consultant or your insurance broker in with us, and let's look at them together to make sure that you have all the coverages as a tenant that the lease requires. And frequently it makes you think about the coverages you don't have for your business interruption insurance. Smaller businesses, startup businesses, forget about the impacts of a fire or a flood or some catastrophic event that shuts down the building because suddenly the road is being closed because the gas blew up and they're going to be closed for 3 weeks. So did you have business interruption insurance? The commercial lease, most commercial leases actually make you turn your mind to it because the landlords say, I want you to have business interruption insurance because guess what? You're still paying the rent even though you can't get into your premises. So it makes you think about it. Review that with your broker. That's just one little kernel example. There's a lot of insurance coverages that you've got to look at. Again, I'm not the expert, but I know how to read it and I know where to point you for the expertise. We were talking about flexibility. A lease offers flexibility. Can you negotiate into the lease the ability to increase the size of your space or decrease the size of your space during the term of the lease or at the end of the term? Is there space available next door or on another floor? And can you get a first right of refusal on that space? Hard to get, but maybe you can. Or can you get a right to notice if that space comes up? That's easier to get. The landlord's perfectly willing to say to you, I'll tell you first if that space is available. And that might be very valuable to your business because you get the first chance to say, and by the way, the chance might only be for 5 days, but you've got the first chance to say, I want that space because I'm busting out at the seams and I'm going to take it. So think about that. And subleases, they're wonderful. They regularly are at below market rates. That's fantastic. They're a deal. The biggest pitfall of a sublease is you have no direct contractual relationship with the landlord. Your landlord is the tenant above you. If they go out of business, you're leasing part of their space, and they stop paying the rent, you've got a big problem. Unless the landlord's willing to recognize you and say, you know what, I won't disturb you, I'll leave you there. But if you're only one little tiny corner, or say you're only one floor of 5 floors that somebody's renting, that tenant goes out of business, the landlord comes to you and says, gee, you know what? I sort of want you out of the building. Adios, amigos. that can be devastating. So subleases there are pitfalls in them. You have to be really carefully assessed and analyzed. Lorraine and I have worked on some big ones and some small ones. They can usually be worked out. You can usually get enough protection, but remember, you're usually paying a lower price for a sublease for a reason. There's an inherent risk in the sublease.
This is just to give you very high-level pointers if you are entering into a franchise arrangement, either as the franchisor or as a franchisee. Franchise agreements are statutorily governed. There's strict disclosure requirements that are set out in the Arthur Wishart Act. Those requirements, there's detailed disclosure. You have to, as a franchisor, there's, you have to have audited financial statements unless there's specific exemptions you can qualify for. As a franchisee, just knowing that there is a statutory framework for your agreement is of benefit. Biggest thing is get help when you're negotiating these agreements, and be wary of personal guarantees. If you're signing the franchise agreement as a corporation, the franchisor may require you to personally guarantee. And so these are just very, very high-level points that you should consider when you are entering into a franchise arrangement. And the last thing that we thought we would talk about in this context of growing your business is your purchase and sale agreements. So, and again, this is another topic we could talk about for an entire session. And I just picked out, 4 things that came to mind immediately, which are: be wary of standard terms. If you are either the buyer or the seller and are using standard terms, or are the buyer and are going to be subject to standard terms, you should at least read them. And if you don't understand something, you should get some advice on it, because there could be all kinds of things in those standard terms that could come and bite you later. If you're hiring subcontractors in your business, often people do it without any form of contract in place. And what happens? How do I get rid of this subcontractor at the end of the day if they're not performing? How do I know they're not performing if I don't have any written terms? Is it IP related, what they're working on? How do I know that I own the product that they've worked on for me? There's very specific things that you should think about when you're hiring subcontractors. Web-based contracts have lots of clients that they're in e-commerce. They deal exclusively over the web, and those contracts, there are specific legal requirements for them to be enforceable. So, the terms have to be obvious, and they have to be, the person who's clicking to agree has to have an opportunity to review those terms, whether they're right there in front of them or they have to click somewhere else to find them. It has to be obvious, and there is no law that says that you have to prove that they have read them, but they have to be given the opportunity to say that they agree with them. Whether or not they've read them, that's another whole can of worms. The other thing to be wary of, especially in e-commerce business, is privacy issues. If you're collecting any form of information from your customers on the web or in any other form in your business, you have to comply with the privacy laws, and they're changing constantly, and it's really something that you should get advice about before just using a standard provision off the web on your site.